Welcome to the deep dive. Today, we're really jumping into office-based solutions. They're a huge name in India's flexible workspace scene.
That's right.
And we're going to cut through all the corporate speak, try and find out what's really going on behind their latest results and strategic decisions, give you the inside track.
Yeah, and for this, we've been looking at their latest unaudited financials. That's for the quarter ending June 30th, 2025, both standalone and consolidated.
Okay.
Plus, we've got the auditor reports, the official press releases, and really importantly, we listened into their Q1 earnings call, get the management's own perspective.
Perfect. So the mission today is basically to boil all that down, find the key takeaways, those little aha moments, so you can really get what's driving Office and where they might be heading. Let's dive in. All right, first things first, the financials for Q1 fiscal 26. Let's unpack these headline numbers. What immediately stood out to you from the results ending June 30th?
Well, on the surface, the reported numbers look pretty strong. Operating revenue was 335 crores, which is a solid 30% jump year on year.
30%, nice.
But, what's maybe even more impressive is the operating EBITDA. That climbed to 127 crores.
Wow.
And that's a 60% year-on-year growth. 60.
So revenue up 30%, but EBITDA up 60%. That suggests some serious operating leverage kicking in, right?
Exactly. Scale is really starting to boost profitability now. You see it in the margin, too. The operating EBITDA margin, it expanded by 710 basis points.
So 7.1 percentage points.
Yeah, hitting 37.8%. And profit after tax, the bottom line, PT, came in at 10 crores. That's up quite a bit from just 3 crores in the same quarter last year.
That's a significant jump.
It is. But what's also really insightful is looking at it on an IGAAP equivalent basis. It sort of adjusts for some of the INDIS accounting stuff, gives maybe a clearer operational picture.
Right. And how does that look?
So on that adjusted basis, the operating EBITDA margin was 14.5% for Q1 this year. That's up from 11.5% last year.
Still a good improvement.
Definitely. And the profit before tax, PBT, was 25 crores compared to 15 crores last year. So whichever way you slice it, profitability is trending up nicely.
Makes sense.
Oh, and one more thing on financials. The annualized return on capital employed, ROCE, for Q1, it hit 67%.
67. That's pretty high. How does that compare?
It's up from 62% for the full last financial year, FY25. So yeah, it really underscores how efficiently they seem to be using their capital right now.
Okay, so they're growing fast, margins are improving, ROCE is up. But with all this expansion, you'd normally expect debt to climb. What's happening there? How's their balance sheet looking?
That's actually one of the most striking parts. Their liquidity position looks really strong. Gross debt is only around 7 crores.
Just 7.
Yeah, which gives them a debt-to-equity ratio, the DE ratio, just 0.02.
Wow, that's tiny.
It's a huge improvement from 0.08 a year ago. And get this, their net debt to equity is actually negative, minus 0.18.
Negative, so they have more cash than debt.
Essentially, yes. It shows incredible capital efficiency. And, this really raises the question of how this financial strength lets them make the strategic moves they're making. It's foundational.
Right, that financial muscle lets them be bold. So, okay, let's shift focus. Where is this boldness showing up operationally? How are they actually growing their physical footprint?
Well, the growth in physical capacity is pretty remarkable. Operational seat capacity is up 40% year on year.
40%.
They're now at just over 140,000 operational seats spread across 220 centers.
Okay.
And if you look at the total network, including the centers they're currently fitting out and the ones where they've signed letters of intent, LOIs, the total capacity is actually over 165,000 seats.
Yeah. Across
246 centers, that covers about 8.3 million square feet. It's a huge footprint.
And where are they putting these new centers? Is there a specific strategy behind the locations?
There absolutely seems to be. It's quite interesting, actually. 100%. Every single one of the new centers they signed between June last year and June this year are in grade A commercial buildings.
100% grade A.
Yep. That signals a clear move towards, premium locations, attracting perhaps larger, more established clients.
Targeting the higher end.
Seems like it.
Yeah.
But also, they're not just sticking to the big metros. Their presence in Tier 2 cities has grown by about 25% year on year.
Oh, they're finding success beyond the main hubs, too.
Definitely. Shows the model is adaptable and, crucially, how they're doing it, mostly through that manage aggregation, or MA model.
Yes, the asset-light approach.
Exactly. About 64% of their total seats
Hmm.
and 63% of centers are under this MA model now. And the MA part itself is growing fast, 32% growth in MA seats, 23% growth in MA centers since June last year.
So they can expand quickly without needing massive capital up front for property. Makes sense. But okay, they're adding all these seats. How well are they filling them? What are the occupancy rates telling us?
Right. Good question. So the overall exit occupancy for Q1 was 73%.
73%. Okay. Is that good?
Well, it's decent, but you have to unpack it a bit. The key thing is, for centers that have been open for more than 12 months, the mature ones' occupancy is actually a strong 84%.
84? Okay, that sounds much better.
Yeah.
So the overall number is dragged down by the newer centers.
Precisely. Management pointed this out on the earnings call. About 32% of their current seats are in centers less than a year old.
Ah.
So those are still ramping up. Their strategy, they said, is to focus on filling up this recently added capacity in the first half of this fiscal year, H1 FY26.
Get the occupancy up.
Yeah, optimize what they have, and then look at resuming more strategic expansion in the second half, H2. So that 73% is kind of expected at this stage of their expansion cycle.
Got it. So focus on filling beds first, then build more rooms.
Mhm.
And who exactly is filling these seats? What does their client base look like? Are they getting sticky customers?
They seem to be doing very well on client acquisition. They signed contracts for 15,000 new seats just in Q1.
15,000 in 3 months. That sounds strong.
It is, especially compared to 11,000 in the same quarter last year. And looking ahead, they already have about 18,000 client seats signed up that are scheduled to move in during Q2 and Q3.
So future revenue already locked in.
Exactly. They said that translates to about 463 crores in locked-in revenue, gives them good visibility.
And what kind of clients are these? Small startups? Big companies?
It's increasingly tilted towards larger enterprises. The 100-plus seat cohort, clients taking over 100 seats, now makes up 59% of their whole portfolio.
Almost 60% from large clients.
Yeah. They have over 50 clients taking more than 100 seats each, and even 9 clients who take over 300 seats each.
Wow. And are these clients staying? What's the stickiness like?
Seems pretty high. 41% of their clients now use office spaces across multiple centers. That's up from 36% a year ago.
So they're expanding with Office.
Right. And the average client tenure has increased to 36 months. The average lock-in period within contracts is 24 months. And over 73% of their clients have contracts longer than 24 months.
36 months average stay. That's quite sticky for flexible space, isn't it?
It really is. It suggests clients see them as a long-term solution, not just temporary space. Across their, 3,200 plus active clients, it really reinforces their value proposition and makes their revenue quite stable.
Okay, so the core co-working business looks solid, growing, profitable, sticky clients. But you mentioned other segments earlier. What else are they doing beyond just renting out desks?
Right, they're definitely building out an ecosystem. If you look at the revenue breakup for Q1, the core co-working rent and what they call allied services brought in 276 crores. That part grew 49% year on year.
Okay.
Then there's the construction and fit-out projects division, which they brand as Office Transform. That contributed 58 crores in revenue.
Office Transform. So they do fit-outs for others, too.
Yeah, exactly. But what's really interesting is the growth within that allied services bucket you mentioned.
Ah, okay. What's in there?
This segment grew 43% year on year, hitting 36 crores in Q1. It includes things like food and beverage services, they call it office care. Then there's tech labs for IT solutions, mobility products, even employee transportation through a partnership with EOS Mobility.
So it's becoming more of a full-service offering, like everything you need for an office.
Pretty much. It's moving towards that integrated workspace solution idea and that Office Transform fit-out business. They mentioned having an order pipeline over 100 crores for that, with margins around 7.5%.
Decent bolt-on business.
But wait, there was something else, wasn't there? A completely new venture announced just today, August 11th. What's that about?
Yes, breaking news. The board just approved entry into a whole new line of business, office furniture and furnishings.
Furniture. Seriously. So they're going to start selling desks and chairs.
Essentially, yes. The plan covers design, trading, importing, exporting, assembling, basically dealing in all kinds of modular office furniture.
Wow. Okay. Why? What's the play here?
Well, they're looking at an initial investment of around 8 to 10 crores, mainly for, product development, finding vendors, prototyping, hiring a team, working capital.
Right. But the strategy, they're framing it as vertical integration. It kind of makes sense, doesn't it?
Yeah.
They already fit out huge amounts of office space for themselves.
So maybe they can do it cheaper in-house. Better control.
Exactly. Cost optimization for their own fit-outs is one angle, but also it creates a whole new B2B revenue stream selling furniture to external clients.
Ah, okay. So it's not just for their own centers.
No. Plus, they get better control over quality, customization, and it positions them even more strongly as that full-stack workspace solutions provider you mentioned.
From finding the space to fitting it out to furnishing it.
Right. And they emphasize doing it in an asset-light way, using contract manufacturing tie-ups so it scales efficiently. It's quite a clever strategic move, potentially.
Interesting. Very interesting. So adding furniture to the mix, what else did management emphasize in their outlook during the earnings call? What was their overall tone?
The overall tone was pretty confident. They reinforced their belief in sustained profitable growth, and they kept coming back to that two-pronged strategy for this year.
Wait.
First half, H1. Focus on optimizing the capacity they've already added. Drive up that blended occupancy rate.
Fill the seats.
Right. Then second half, H2. Resume strategic but calibrated. Expansion based on demand, market potential, and crucially, capital efficiency. They seem very focused on profitable growth, not just growth at any cost.
Okay, makes sense. Now, I know on these calls there are always questions about competition, market pressures. Did anything interesting come up there? Concerns about the IT sector, maybe.
Yeah, those points definitely came up. Regarding competition, management argued their model is distinct. The larger average center size, the high MA mix, 65% now the profit share approach.
They feel that differentiates them.
Yes, plus their wide network, 18 cities, over 60 micromarkets, they feel that scale is a barrier. On the IT sector, which is a big chunk of their business, like 35–37%.
Right, you'd worry if that sector slows down.
Well, they reported no decline in demand from ITites. They said growth from India-focused IT companies and especially global capability centers, GCCs.
Those big offshore hubs.
Exactly. That growth is apparently offsetting any potential softness elsewhere in IT, and they highlighted their churn rate remains very low, around just 1%.
Only 1% churn. That's impressive. What about pricing? Any pressure there?
They addressed that too. Management said there's no underlying decrease in average seat prices. In fact, they said the trend is generally upward, driven by rising commercial real estate costs.
Okay.
But they did explain that the average price reported in any given quarter can fluctuate, maybe because they opened a new center in a cheaper micromarket or just due to the timing of when new clients move in during the quarter.
So temporary blips, not a downward trend.
That was their message. And for future margin expansion, they pointed to, well, getting that blended occupancy higher as new centers mature.
Right, more mature centers are more profitable.
Exactly. Plus, operating leverage from scale, their premiumization efforts like adding more elite and gold centers, using more grade A buildings, even within the MA model, and, of course, continued growth in those high-margin allied services.
And they have a long-term target for margins.
Yeah, they mentioned aiming for an 18–20% EBITDA margin in an ideal long-term scenario.
18 to 20%.
Okay.
Now, you mentioned elite centers. Is that separate from the MA model? Are they moving away from asset light for the premium stuff?
That's a great question, and it shows how they're trying to balance things. They have 3 elite centers live now, about 2,800 to 3,000 seats in total.
Okay.
And plans for maybe 3 or 4 more this year. Now, some of those are on a straight lease model, which is more capital intensive.
Ah, so not MA.
But they specifically said they are actively working to bring even premium grade A assets and potentially even future elite centers under the managed aggregation umbrella.
Really? Even the super premium ones?
Seems so. It shows they're really committed to that capital-efficient MA model where possible, but they're flexible enough to adapt it even for their highest-end offerings. It's quite an adaptive strategy.
Fascinating. So trying to get the best of both worlds' premium offerings, but still aiming for capital efficiency. Okay, and just one small administrative point from the board meeting today.
Oh yes, just a quick mention. They appointed Mr. Rupinder Singh Bhatia as their secretarial auditor for the next 5 years, starting back from April 1st, 2025. Standard governance procedure.
Got it. Okay, so let's try and wrap this up. If we boil down this deep dive, what are the key takeaways about Office right now?
Well, I think first is definitely the strong Q1 financial performance. Good revenue growth, even better EBITDA growth, improving margins, strong ROTE. It feels like they've hit a profitable stride.
All right, the engine is humming.
Second, the operational expansion is impressive, but also strategic, focusing on Grade A, expanding in Tier 2, and heavily leveraging that capital-light MA model.
Smart growth.
Third, the client base looks increasingly solid. More enterprise clients, longer tenures, good forward visibility on revenue. They seem to be building real loyalty.
Sticky customers.
And fourth, I think, is this move towards becoming a full-stack provider. Growing allied services, and now this jump into the furniture business, it shows ambition beyond just co-working.
Building an ecosystem. Okay, that's a great summary.
Which, it really makes you wonder, doesn't it? It raises an important question for you, the listener, to consider. How will this integrated ecosystem approach, combined with their relentless focus on capital efficiency, position offers for leadership in India's really dynamic, flexible workspace market over the long term? And maybe even what does it signal about the broader future of work itself?